Welcome, everybody. On behalf of the Ascension Parish Library, I thank you all for joining us for this first session of creating a financial scoreboard using numbers to build a better business. Your mics have all been muted to avoid background noise. I am pleased to present today's guest speaker, Ms. Benita Benta-Rice. Ms. Rice has over 20 years of corporate experience working with C-level executives in several roles: asset management, management analysis, and project management. Please join me in welcoming Ms. Benita Benta-Rice.
Hello, everyone. Thank you so much. First of all, let me say thank you to the Ascension Parish Public Library for inviting me, both Donnie and Chriselle, for inviting me to present in this series. One of the reasons why I love presenting on financials is because I've worked in it so long, and I see a lot of times that there are people who are not familiar with it, and I just know the power that is stored within the numbers once you understand what the numbers mean. So welcome to the first of two sessions titled Creating a Financial Scoreboard. During both sessions, we'll focus on identifying and understanding the numbers that matters and why those numbers matter. Please place any questions that you have in the chat so that I can respond to them at the end of the presentation. So again, welcome and thank you for attending tonight's training. Since you've already heard my bio, and I thank her so much for keeping it short, so thank you so much for keeping it short. I would prefer to learn more about you over the next 4 weeks. And so over the next 4 weeks, I'll be asking you various questions about yourself and your business so that I can personalize the information that I'm providing you. Is that okay? All right, if it is, then we'll move on. So unfortunately, okay, one of the reasons, and I say unfortunately, one of the reasons why I love this topic is because I came from a family of small business owners. Both my mother and father both had small businesses. A lot of my friends, their parents had small businesses. And so along the way, what I noticed is that as we got older, we went and got jobs. We did not get small businesses. And so I was wondering why. So that was an epiphany I had about 12 years ago. I'm like, why is it that none of us have continued our parents' small businesses, even though we worked in them all our lives? And one of the reasons why is because, after I spoke to my friends, one of the reasons why is because they didn't see the success that their parents see. They saw that it was a lot of work. They wasn't sure whether or not they were making any money. These are the things that they thought about. And so I selected this topic because I wanted to make sure that every small business, every entrepreneur, and it's not just small business, because believe it or not, all businesses have this problem, large and small, because I worked in large companies. So all businesses have this problem. So that's one of the reasons why I wanted to pursue this line of topic. Okay, so who's this class for? This class is for bookkeepers, it's for accountants, it's for entrepreneurs, it's for the wannabe-preneurs, it's for everyone. It's for the established business owner, it's for the administrative assistant, it's for the bookkeeper, it's for the line cook, it's for the restaurant manager. I mean, there's no way in the world I could even begin to exhaust answering that question. Who is this class for and why? But the why is really the critical part of it, because the why is that I want all of you, as I mentioned before, to succeed. But most importantly, I want you to understand what you're looking at whenever you get a financial statement. Okay, so let's talk about the bookkeeper. First of all, let me say that this chart emphasizes the key person in a company that has the responsibility for ensuring that the business remains in operation. So that's why we have the bookkeeper. That's why we have the accountant. That's why we have the managers, and that's why we have the owners. We have the investors, because if the business is not growing, the investors are going to not fund the business owner anymore. They're not going to stick around. They're going to go on to the next investment. We have the bookkeepers, because the bookkeeper is the information, the origin of all information that the owner must read. The bookkeeper provides valuable information, but it's only important if the data is correct and timely. That is so important. If it's incorrect, the business is going to fail. If it's late, the business will not grow, because the company owners cannot make any kind of decision based upon old, notice I said old information. And the reason why I said it, because oftentimes most business owners do not look at their financial statement until the end of the year. And everything is a surprise. They don't have aha moments. They have oh moments. It's totally different. We need more aha moments. If it's incorrect, the business will fail. The business will not grow. Means the transactions such as sales, inventory, paid and unpaid bills are may not be accurately entered into the financial accounting system. And if it's not accurate, again, you have wrong data. You can't make good decisions. The accountant role in this case is a little bit different. Now, the accountant can also be a bookkeeper, but what the accountant must be is an analyzer. They're not just supposed to spit out financial information. QuickBook will do that for you, whether or not it's right or wrong. The accountant is supposed to study the financial information and make it make sense to the owner. So when they are looking at sales, they're not just looking for the dollar value. They're supposed to tell you what's good and what's bad in your sales report. When they're looking at inventory, they're supposed to be looking at ways to save you money by analyzing the data. When they're looking at paid and unpaid bills, they're supposed to be looking at whether or not you're taking too long to pay your bills and how to speed up that process. And this is true no matter what accounting system you use. It doesn't matter whether or not you're using QuickBooks, FreshBooks, Sage, or an Excel spreadsheet. Your accountant is supposed to be analyzing the data that is being produced. And if they're not analyzing the data, if all they're giving you is two pieces of reports, a financial statement that comprises of a balance sheet and an income statement, if that's all you're getting, and with no explanation as to what transacted during the current reporting period, then you are being cheated on. So yes, I am calling all accountants to a higher standard so that you guys can all succeed. The accountant role is not just to make journal entries. I've said it before and I'm going to say it again. It's not just to reconcile the balance sheet. Okay, the bank statement. It's not just to reconcile the bank statement. That's important, but that's dead information. The accountant should be focusing on getting those things done so that they can tell you what your next, provide your information as to what your next move should be. So they're sort of like they're supposed to be something like an advisory role. And if you guys have any questions about any of this, just please put it in the chat line and I'll respond at the end of the training. But I just want you to understand what are the roles here and how critical they are, and what you as the owner should expect from the people who have these roles. Now, if you are an owner that have a manager, your manager is important to your company because his role is asset protection. His or her role is asset protection, asset management, people and skill management. That's what your manager's role is: asset protection, asset management, and people and skill management. His secondary role is a trainer and a motivator. The way how your manager behaves will basically determine how high your turnover rate of employees will be. So you have to manage well. You just can't get up and say, oh, I'm going to put my cousin in charge because they need a job. Yes, they need a job, but maybe what they need is managerial training first before they get the job. You're supposed to focus on hiring a good manager, because a good manager is going to know what to do to keep your employees motivated, to keep their skill levels high, to reduce the amount of turnover you have in your employees. That means the employees are always quitting. So that's why knowing a manager and hiring a good manager is worth every last bit of dollar that you're going to spend. So don't be skimpy. Don't go for the $8 an hour manager. You need to go for a manager who has experience, who has good character, who has patience, who knows how to speak to employees, who are not there just to look good, who are not there to flirt, who are there to really manage your resources. We always hear that time is money, but people is also money. And every time you lose an employee and you have to hire one again, it's going to take you 4 months just to recuperate the cost. So you're literally losing 4 months of revenue waiting for that new employee to get caught up to speed. That is why you have to hire well. So the other part of that, of course, is the owner. I'm going to talk about the owner in depth some more later on. But what I do have to say to the owner, if you're online here watching this presentation, is that as an owner, you have to learn to do what I just told you the manager should do. You're supposed to be able to train. You're supposed to be able to communicate. And you're supposed to be able to delegate and create benchmarks so that your manager can reach those benchmarks, and so that you can see whether or not your choice is correct and whether or not you can give that manager more authority. You don't give them more authority. You still have work to do, owner, but you do have to make sure that your manager and your employees are trained properly so that they can accomplish the mission of the business that you're in. That is very, very, very important. So, okay, so we're going to talk about the primary functions in the business. Honestly, most people start out by marketing and producing. That means that you're going out there, you're trying to hustle and get the work, sign a contract, or write an invoice, a bill of lading or something, and then you're coming back, okay, and you're creating the product, the services, whatever it is, you're doing a job, and you're getting it back out to the customer. But I want you to imagine this scenario. Just take a minute and just stroll down this scenario with me. Imagine a stool or chair with one leg. It only has one leg. Now we know that if the stool, let's going to use the word stool, manages to remain upright long enough, okay, it can stay upright long enough, but as soon as something brushes against it, as soon as there's a slight vibration, it will fall. Can we agree on that? It will fall. So, say for instance, you yourself are someone with acrobatic abilities, and you decide that you're going to prove that the stool will not fall. So you go and you stand on the stool, you maintain your balance. Remember, the stool still have one leg, and the stool does not fall. Now, your manager comes along, or your children comes along and say, well, I don't have to stand and hold my balance. I can just sit on it and it will not fall. They are right. That's because assuming that they have both legs, they will be able to balance the stool in an upright position. Someone, however, will have to hold that stool if you want them to get up without the stool falling, okay? So, because as soon as you move, the stool will fall. Now imagine that the stool has more than one leg to keep it from falling. You can walk away and it will still be upright. How many legs would be necessary to ensure that the stool remain upright? Would it be 2 legs, 3 legs, or 4 legs? If it's 2 legs, the stool still have the ability, it may stay up for a little bit longer, but eventually it's going to fall. The minute you apply any kind of pressure to that stool, if it's not placed smack dab in the center of it, it will fall. Let's assume the stool represents the business owner. That's really who I'm talking about, is the business owner. The owner's responsibility is to market his goods and services. It's also, he or she's also responsible for acquiring or producing additional goods or increasing the level of services offered. Well, you pretty much have to have something to give to the customer when they show up, because it is very hard. And when I say you have to have something to give to the customer, I'm saying to you that you have to have a goods, you have to have a service, you have to have something to present to the customer when the customer show up, if you want to keep that customer. So you have a manager, an owner. We're not even talking about a manager now. We're just talking about an owner that is fully involved in their business. They're responsible for marketing, they're responsible for production, and though they're responsible for everything. And so this owner has to juggle all of the roles, all of these roles, marketing and production. You say that's only 2 roles, but that is a lot of roles. And it's very hard for a single person to juggle all these roles and grow the company. So they'll need additional resources. What type of resources do you think they need? Human resources. Okay, and they'll need good help. Okay, good help, not the pie type of help. This help comes in the form of humans. The humans are the resources that the business need to execute functions associated with the business. That's why it's called human resources. If you don't have additional good help, remember, I'm not talking about the pie type of help. I'm talking about human help. If you don't have good human help, then you will not be able to grow and expand your services and expand your offering, or even earn the type of revenue that you need to sustain this business. So now we're talking about 3 functions of the manager, the owner, the owner. The owner now, he has marketing, he has production, he's the person who's doing the sales, he's the cook and bottle washer, or he's the person who's doing the delivery. He's just all over the place. And in order for him to grow that company, he's going to have to pull back from one of these functions, maybe even 2. He's going to have to pull back and allow someone else to come in and assist it. So those are the primary functions of the business. Okay, so now we're talking about accountants. The accountants, they have a big responsibility. I mentioned them before. The function of all business is to make money. And for it to do so, someone must market its goods and services. Someone. We said the manager was going to market. Now the manager is at the point now he can decide to hire somebody to market. It must produce and obtain and have available the same goods and services so that when the customer shows up, he or she will have something to sell. I mentioned that before. Production, which is labor associated with the sales of goods and services. So the goods and services that he has to sell is part of his production. The labor can be both internal and external. Your staff is internal. The people who produce the goods and services or sells the goods and services, they are internal. The people who provide you support and services can be external. Those are your accountant. It could be a bookkeeper. It could be a deliverer. You know, now we have all these different companies that are hiring people just to deliver. Those are external companies that are providing goods and services. Ultimately, since the goal of the company is to grow, it must have a way to measure its growth. It must have a way to measure whether or not it is successful in its business. It must have a way to study the results of its activities on its business. They will do that by using both accounting records and metrics. Now, you guys all know what accounting records is. I don't think I need to go into much details, but I will. But I want to focus now on the metrics part of it, because a lot of business don't look at metrics. The metrics are the critical aspects of the business. It's actually the most important factor when you're thinking about how you're going to grow this business. Metrics are things such as the number of customers per day when you have a lot of customers versus how many customers you have the next day when you have a few. Not only do you want to know how many customers you have each day, if it's less customers tomorrow, you want to know what day it was, because Wednesday might just be a slow day. Is it always Wednesday? You have 20 people Monday, 5 on Wednesday. Those are the metrics that you're going to compare. Another thing you're going to look at is the products that you're selling. What is selling and what's not? You may have a shelf full of, for instance, if you're into pharmaceutical sales, you may have a shelf full of aspirin because, everybody's going to buy aspirin, and you may have 5 Tylenol or Excedrins. And you're constantly running out of Excedrins, but you don't realize it because you're not studying how many items are being sold, what number, what quantity of that particular item is being sold versus another. Those are some of the things that you have to look at. Those are called metrics. Another thing that you have to look at is to see your cost. So if you're buying, say for instance, cereal, okay, you're buying cereal. Who's selling you the same box of Kellogg's cereal for less? Do you want to keep paying Sam's for this Kellogg's cereal by the case? Or do you want to go to an authorized distributor and get that same case of Kellogg's cereal for much less? Because these metrics, if you study these metrics, it leads literally to more money in your pocket. But most people don't study metrics, and therefore they are leaving money on the table. Now, let's not talk about those metrics that's impacting your dollars. Let's talk about metrics that impacts customer satisfaction. One of those things is feedback. What are your customers saying about you? What are your customers hinting to you when they come in? If you have a customer that keeps showing up and then one day you notice they're not coming at all, you need to ask them why. It could be bad service. It could be someone in your company is making them feel uncomfortable. It could be that you never have what's in stock. Feedback is so important. That's why one of the things that the internet has done is make it easy for people to track their customers, get feedback from their customers, get customer satisfaction surveys. Yeah, it's nice to have a pipeline of leads, but what's more important is analyzing your existing customers, talking to them, getting feedback so that you can make sure they are happy, they're satisfied with what you're offering, whether they are fully sure that when they come to you, they're going to get the best quality product. That's metrics. From the flip side, accounting is simply accounting. We're looking at your balance sheet, we're looking at your income statement, and you're looking at cash flow. And as we go along, I'm going to show you how to look at your financial statement so that you can make good decisions. In fact, I have a scenario at the end of it that will be very beneficial and will bring all of these things together. Right now, I just want to make sure that you understand the value of the information that you have, what you don't have, and why you need to incorporate the things that you're not studying into your daily routine. I know in Louisiana, construction is everything. Everybody, I don't care what you are. You could be a bookkeeper. Everybody's making money in construction. It seems like you go get your license because you can be a residential contractor. You're now a GC. That seems to be the thing here in Louisiana. However, but I won't use the word however. Even though it's construction, you can still measure metrics. Are you getting done on time or before time? does the customer have to call you back to fix something? Did you not level the floor when you put the tile in? Is the tap dripping? Those little things can make or break you. It really can make or break you, your reputation, because nobody wants to keep calling a contractor back and forth to do things. So if you're in construction, those are the metrics that you have to measure. How satisfied is your customer 30, 45, 90, 120 days, a year later? You got to go back to that customer and say, how are you doing? Are you satisfied with what I've done? Are you still satisfied with what I've done? Will you be willing to refer me to someone else? Because I'm telling you, if they're not satisfied, they may not tell you this, but they're going to tell everybody on the block that you ain't any good. And they're going to leave your sign up in front of the house so that people can come up and say, hey, did JC build your house? And then you're going to say, yeah, but girl, this house ain't crap. And I'm sorry if JC is on this call and hear me use him as an example, but I couldn't help it. But that's what they're going to say. JC is a very good contractor, so I know for a fact that this does not apply. But I'm just simply saying, if you left your sign on somebody's lawn and they're not happy, they're going to tell the whole block, because the whole block's going to stop and ask, are you satisfied with that contractor? So let's go back and look at the example of the stool again. What do we have here for this stool? This stool has 4 legs. Each of those legs represents one of the functions on the side of it: marketing, production, human resource, and accounting. If you have your goal as a business person is to get to the point where you can, and the quicker you get there, the better you'll grow, where you can hire effective people in those fields that can support your company's growth so that they can give you timely information. If you do not have those fields, those positions filled, whether internally or externally, and I'm so serious, you will not be able to meet the growth potentials that you want to meet, or have the growth potentials that you want to have. Okay, so we're going to talk about the journal ledger. What time is it? Okay, I might have to speed up. I have to show you what the old journal ledger is, and that's because this is what I grew up. The first one is what I grew up doing. My dad used to have us sit and filling out this form. Every single day we got home from school, we were sitting in his office filling out this form while he went to the beach to get a break, okay? When I went to high school, of course, I'm not from here, and in high school, I had the opportunity to begin to learn accounting my third year of high school. The second section, journal entry format, is what I learned in high school, and it's still being used today when you go to college. They're going to teach you this format. They're not going to necessarily teach you QuickBooks. QuickBooks is a software. They're going to use a second format, the second journal entry format, to get you up, to teach you, I should say, to teach you how to understand accounting, okay? So I know many of you may not have ever seen this. And I know many of you have seen it, because a lot of people went to business school and then branched off into every field, or to another field, I should say. Well, some people do every field, okay, but it's another field. At the end of the day, in the back of your accounting software, whether it's a Xero, Cashew, Sage, QuickBooks, or FreshBook, in the back of your accounting software that you cannot see, the double entry system that you see in front of you today is what's taken place, or should be taking place, in these softwares. The problem is, guess what? You don't necessarily put all of the information in QuickBooks. So if we look at the bottom here where it says particulars of a business transaction, where you have the rent, you have the insurance, and then you have the bank account. That's February 17, 2019. Most times, well, I won't say the average. There are a lot of people out there who would not record this transaction in QuickBooks the way it is. Okay, we have debit entries and we have credit entries. They would not have recorded the transaction in this matter. And what you have is that you have a financial statement that have a whole bunch of negative numbers on it. I'm sorry, a financial statement should not have a whole bunch of negative numbers on it. It shouldn't have a line that says negative anything. When you see a negative number on a financial statement, especially from QuickBooks, it's because you did not enter all of the transactions. And so QuickBooks cannot match it to anything at all. So we're going to go into details. I don't want to spend a lot of time on the ledger. I do want to take you back to this chart because this chart has more to offer you than just bookkeeper, accountants, manager, and owners. The whole reason why you're in business is to make money. The red line represents your expenses. A lot of times people are redlining. They are redlining. They have more expenses than they have in revenue. The green line is profit. And we know that if you subtract the expenses from your revenue, what you should have is profit. I don't want to go beyond, I don't want to go ahead of myself, but I just want to point out that what most people have by the time they get to the end of the financial statement is a loss. And I'm going to mention one of the contributing factor to that loss. But let me focus on this chart right here. Normally, when I review people accounting and financial statement and accounting transactions, as soon as I see people who know me is going to hear me say, fire your accountant. They're also going to hear me say, fire your CPA. Now, I can't make them fire anybody, but I can tell them, I'll circle it. This is wrong, this is wrong, this is wrong. Tell them to give you a detail of what's in this field. Tell them to print out a detailed transaction history report on here. This particular item must be manually closed up. I cannot tell you how many times I'm literally making notes for people to give to their accountant. Because again, they don't understand the double entry system and they are just relying on QuickBooks to be their genie. Well, we know all what happens in I Love Jeannie. If you're my age, you've watched I Love Jeannie, and we all know what happened to the major in I Love Jeannie. He always ended up somewhere wrong, and that's what's happening with most businesses. Their reports are incorrect. They're not making decisions based upon good information, and therefore they're going to make the wrong decisions and end up somewhere wrong. If you are, so let's talk about this role of the accountant again, okay? If you're an in-house bookkeeper, then you should have someone else look over the entries that are being made. So that means you have to have the external person. One of the reasons why people pay so much money at the end of the year to get their financial statement done and to get their taxes done is because they wait until the end of the year to do it. And then there's all this work that has to be done versus if you have it done each month, okay? One of the rules I'd like you to implement in your business is to tell your bookkeeper you want your financial statement within 5 days of the close of the month. This is critical. Now that means your bookkeeper is gonna have to decide, okay, I'm gonna charge you for priority. That's good, because it's going to save you money in the long run. Okay, so they're going to say, I'm going to have to charge you for priority, or if they're not, that's if they're not big enough, or if they are large enough company, they're going to assign a dedicated staff to you. Or you can even go to your external accountant and say, can you put a dedicated staff in my office? It's almost like staffing, but at least you'll have a knowledgeable bookkeeper or an accountant in-house that's working with your CPA, and it will make things a whole lot smoother. But here's why you want your financial statement within 5 days of the month, the end of the month. Everything that happens in your business cycle has an effect on the next business cycle. So anything that happens in the month of February has an effect on March, and it will have an effect on April. Anything that happened as of December 2019, if you haven't seen your business, your balance sheet and your profit and loss by January 5th, you're going to make the same mistakes for the first 6 months of 2020. You need those financial statements in the first 5 years the first 5 days so that you can correct your actions, so that you can change a course of action. If you're studying your inventory, you know that half of the things on your shelf is not going to be sold for 90 days. You do not need to order 90 days of inventory. You need to order 30 days of inventory and have the supplier bring you back another 30 days of inventory. Okay? If you are providing services to someone, then if you're looking at your financial statement, you're able to identify whether or not that person has paid you as agreed. Now, a lot of times, most of you do not charge an interest on unpaid bills. You should. You should charge an interest. Sometimes you put it on there, and it's like a fashion statement. 2% if not paid within 10 days. Guess what? They didn't pay you within 10 days, and you did not charge them 2%. Because you did not want to hurt their feelings. Feelings don't matter in business, only money do. And if you don't keep up with your financial statement on a regular basis, you will find that instead of you getting your money, somebody else is charging you because you are not able to pay them the money that you should have been able to pay them. There's a statement that says you cannot squeeze water from rocks unless you're Moses. So you have to therefore you cannot make good decisions on bad books. If you can afford anything, and don't be afraid to do this, because I've heard a multi-million-dollar company, after sitting down in their office and speaking to them, I've heard them say the one thing, if I could go back and change one thing, I would sleep on the floor and hire an accountant. Because I would have rather avoid the mistakes that I made because of lack of information. And I'm telling you this, the first person you need to hire is an accountant, not a bookkeeper really, but an accountant, somebody who can study your books and provide you insight as to how the transactions for the month is affecting your revenue, how it's affecting your assets, how it's affecting your liabilities. That's what you need to hire. And then when you hire the bookkeeper, that accountant will already have standard policies and procedures in place so that that bookkeeper can follow those standard policies and procedure and maintain your book to a satisfactory level. So again, if you can afford anything at all, hire your accountant. The first thing the accountant is going to do is clean up your inaccuracies. Most of your books is not accurate. You don't need an auditor necessarily to find out that it's wrong. But if you keep going for too long, you will need an auditor, and you will need an audit, and you will pay an auditor's price. Okay? So you need to have these inaccuracies cleaned up. You cannot proceed unless you can identify data in your financial statement that should be examined. Another thing you need to do, you need to compare. And I'm going to talk about that a little bit more. You need to compare your data. Your data, you need to compare them over several periods of time. And in order to understand the impact of your services, impact of the purchases that you're making, the sales that you're making, your marketing effort, your assets and your loans, and all these different things, in order for you to understand those things, you have to clean up your books. So that's the first thing you need to do, is have somebody go through, look at all of your transactions, remove duplicates. You have a lot of duplicates in it because you made invoices and you never paid off the invoices. Have it all cleaned up. One more thing I want to show you, well, not one more, this is the same thing, but I'm going to show you several times. I want to show you this example of PepsiCo Inc. This is I kid you not, I've been seeing PepsiCo in every textbook I've known ever since I came to America. When I was in Antigua, all of our books had British companies in there. Now in America, PepsiCo is king when it comes to the textbook. They happily share their financial statement with you. I just want to let you know those numbers are in the millions. So it's not 57,000, more like 57 million. Okay? But no, what I want you to notice is that this financial statement is comparing two periods, 2010, 2019. Okay, when you have someone prepare your financial statement, you need to let them prepare it like that. Give you last year and this year's information. Another thing you need to ask them to do is to tell you what's the difference between both years. So in 2010, you made $57,000 in sale. In 2009, you made only $43,000. The difference is $14,000. But guess what? You had more sales. You know, your sales increased, which is a positive thing from 2009 to 2010. The final column tells you how much your sales increased. So your sales increased 33% or 34%. That's the kind of financial statement that you want from your accountant or CPA. You want to at least be able to see at minimum the basic growth. Look at interest expense down here. Let me show you interest expense right here. In 2010, your expenses was $903. In 2009, your expenses was $397. Now you're paying $506 more in interest expense than you did in 2009. That's 127.5%. What can you do with that information? Well, to be honest with you, you use this information to decide where can you cut costs. If you see that your interest expense had grown so much, you need to ask yourself, where is it coming from? Maybe I need to pay my bills on time so that I can reduce the amount of interest expense that I'm being charged. Okay, same thing with selling an administrative expense. The amount of administrative expense went up from $15,000 to $22,000. Your job is to find out why it went up. Your accountant, I should say, job is to tell you what caused it to increase, because it may be an anomaly. I've known people who have found out that their employees were stealing. I kid you not, they found out their employees were stealing when they finally examined what made the difference between selling administrative expense. If you take fraud as a class, that's one of the first things that they're going to tell you. That look through your expenses to make sure your employees aren't stealing. Now, we all want to know we have trustworthy employees. That's so important. But we also do know that we don't always have trustworthy employees. And we also know that you can be overbilled by Entergy. We also know that your electricity bill can be wrong. All these things you will be able to identify by looking at your expenses better. So what I did was I took exactly what they gave you, and I wanted you to see what it looks like on a spreadsheet. And I gave you the formulas right here. So you see where it says variance? They had amounts, I call it variance. It's the difference. That's what we use, is the difference. And I showed you what the formula was. I subtracted 2010, 2009 from 2010 revenue. And I showed you what the percent change was. I took the variance and divided it by the older year. And that way, so the older year is 2009. So I took this variance right here and put it on an equation where the 43,000 is at the bottom and the variance is at the top, and the numerator versus denominator, and I got a percent. That's how you get that percent change. This is such a powerful statement, y'all. Y'all don't understand what you can do with this powerful statement. I ran a whole division based upon this statement. I'm telling you, I created this statement every year. Every month, I should say, every month. And by the 5th of the month, my statement went to the CFO, the CEO, and the CIO. They knew exactly what impacted the bottom line. They knew if we sell. So it was a telecommunication and a trading company. Little known fact, the telecommunication was making a killing, okay? Because they had to have They had to keep all that stuff in-house. Everything was monitored. Every phone records was tracked. Everything was recorded. Everything was recorded. And so they knew exactly how many equipment was recording, how many equipment was in use. They knew who had them. They knew everything. And because they charged for the use of those equipment, I could tell them whether or not we installed new equipment. And when we installed new equipment, equipment cost was much higher. So I could tell them exactly how much equipment they installed in a particular category and what the impact would be on the monthly revenue moving forward. That's what this statement does for you. As an owner, that's what you want to know. You want to know when you buy something, how much additional revenue is going to give you. You don't just buy a truck because somebody said, man, I'm going to write this off of my taxes. Yeah, it looks good, especially if you buy the right type of truck. But if you're not going to use it to generate revenue, why buy it? Just because you don't want to pay taxes, you still got to pay the note. Those are the things that you have to analyze when you are deciding to make decisions for your company. So what do you need to know? An income statement doesn't track or report on the cash in your business. It does not. I'm sorry to disappoint you. You can't look on your income statement and say, I got $50,000 cash in my business just because your net profit said that. That's just paper, okay? It doesn't show what transactions are going in and out of your bank account. You can look at your bank balance every single day, and I can't tell you how many people tell me that's the first thing they look at is their bank balance on their banks in their bank account. However, that doesn't tell you all the bills that you have about to come in. If you don't have a crude financial statement, you would not know what's about to hit your bank account. And if you have $50,000 in it and you think the $50,000 is free cash flow money, and you have $80,000 in bills that are about to come in, whether or not it's for asset purchases or product purchases or services that you bought in advance, if you don't keep track of all that stuff, the transaction, the balance in your bank account is not going to help you to make the decision. And before you know it, in 5 more days, your account will be negative. I have this thing for the 5 days. Here's what you need to know. Most transactions shown in your income statements should be accrual based. However, it's not. If it's recorded when it happens and not when it's paid or when you receive the cash, you are not, I'm sorry, but you don't have good financial statement. You cannot make any good decisions here. You have to record the transaction when it happens, not when it's paid or when you receive the cash. I don't know how you keep up with who owes you. Anyway, use the values in your income statement to monitor and manage your company's expense and revenue profitability. Use that. You know what you're supposed to do with your bank statement? You go over every line item, and if you cannot vouch for anything on that line item, you need to ask somebody. I remember one time I was looking at somebody's, what did I ask them? Oh, I was looking at their financial statement. I'm like, what in the world is this? So I said, could I see your bank statements for, whatever. They sent me their bank statements. I look it over and I'm like, what is this? And so I asked him, I said, what is this charge? And he said, well, I'm not sure. I said, do you think this charge has anything to do with paying something over the phone? And he said, I don't know. But why would I? Because I don't pay anything over the phone. Sure enough, guess what? Somebody in the office was paying their bills using his bank account. You guys have to pay attention to your bank account. Forget looking at how much you have in the bank. It's wrong anyway. That's just money in the bank. It ain't telling you nothing about what you owe. Start looking at each transaction on your bank statement and be able to vouch it back to either a receipt or an invoice or a credit card or debit card that you have in your possession. Here's another thing you need to know. Revenue increase does not mean that you are profitable. Sometimes, what I've noticed is that people get money for contracts but they did not price the contract properly. They did not manage the contract properly. They did not seek out the best terms they can possibly get for a particular purchase. And so therefore, what they have is they made very little money. So one of the things I'll tell you, I'm going to share it with you because I share it with everybody else. If you're into construction and you are buying a lot of products from a supplier, you need to negotiate a per item discount. So if they're charging you $50 for, well, okay, I'm exaggerating. If they charge you $1.50 for a cinder block, and you'd go back and say, hey man, can we negotiate? Because every business is going to negotiate. I'm telling you, find one that negotiates. If they don't negotiate with you, they don't love money. I'm telling you that. So if a cinder block costs $1.50 and you go in and say, listen, I'm going to be building a house and I need 50,000 cinder blocks, multiply 50,000 by 2 cents. You go in and say, can you knock off 2 cents off of this cinder block? Just 2 cents. It may not seem much. I'm going to add it up. 50,000 blocks by 0.02 cents. If you find it, type it into the chat. That's $1,000, y'all. Imagine if you ask for 4 cents. That's $2,000. That's where your savings come from. Sometimes you cannot negotiate your pricing. Sometimes you cannot increase your profit margin. However, you can save on per unit items that you're buying in bulk. So that's why I'm saying to you, revenue increase does not equal profitability, because you have not looked at the cost, the expenses associated with making that revenue to ensure that you got the best bang for your buck. So here's a picture of a balance sheet. Real briefly, what does it represent? Current assets, fixed assets. Together, those represent your total asset. Current asset can be cash, cash equivalent. Cash is king. There's a whole separate ratio that will tell you how long it's going to take for you to pay off a debt, or how much dollars are you making over each expense. Okay, then you have liabilities. Liabilities are what you owe. Accounts payable, you owe the current portion of your loan, the current portion of your lease, the income tax that you did not pay. You need to pay it, y'all, because you're going to be charged interest. Your deposits that you got that you're going to have to give back. So when you go on a construction site and they take I forgot what they call the deposit, but when they hold on to like maybe 10% of whatever it is they're going to give you as a guarantee, that's a liability for them, but for you, it's an asset because you're going to get that money soon. Okay? Loan payable long-term. So your long-term debt is anything over a year. Because most of you only do your balance sheet, really only do your balance sheet 1 year at the end of the year, or you run a balance sheet report, but you don't adjust it for a 12-month period, what you're seeing is usually incorrect. Your balance sheet must cover 12 months. And so if in March, you owed $75,000 in long-term debt, and come November, you're still showing me $75,000. The truth is, come November, you need to show me 12 months out for me to know what my liabilities are over the next 12 months. Everything on your financial statement balance sheet is over the next 12 months. 12 months is equal to a year. Another thing you have to look at is equity. We talked about equity. I don't need to beat the dead horse, but I just want to let you know it's your ownership stake in business. It could be the amount that you contributed to your business, but even though it says on paper 10 grand, I know for a fact you don't have that 10 grand. So I'm not looking for that 10 grand. I want to see what you kept in your business as of this year. So that means when you run your financial statement and at the end of it, you had $50,000 in net profit after you took out your distributions. then that 50,000 is what I'm looking for plus the previous balance. I'm not even going to count that $10,000 that you put in when you start the business. It ain't there no more. I'm just being honest. It's not there. It looks good on paper, but you don't have it. I'm only going to count. I'm actually going to adjust your equity by that $10,000 to reduce it. And then I'm going to add what you left in the business last year to what you leave in the business this year. And as far as I'm concerned, that would be your equity. Retained earnings is the amount of money that's left over, left in the business, after it has paid out its debt and dividends, okay? So that's a little line item that nobody ever checks. It is so old that they can't even tell me what's in there. Yes, that's that little line item right there. It's wrong. Have somebody go check it, make sure, clean it up, scrub it. It's wrong because it's been the same number for about 20 years, right? And then you have another line at the bottom called retained earnings. You can't have two line items for retained earnings. So the red flag is go to somebody who can do your book properly and tell them to either fix it, do some journal entries, correct it so you can have clean numbers. Net income, I already told you, is brought over from the income statement. I've told you that your shareholders take a distribution. The distribution comes from profit, but you can't take all your profit. If you take all your profit, guess what you don't have? Money? Yes, you don't have it. It's not there, okay? So you can't spend all of your money. A portion of your profit can and should be reinvested back into the company for growth purposes. So how about you do this? Every time you make a sale each year, take a portion of that sale. It could be 5% or 10% and put it in another account. I tell people all the time, you need 3 accounts. You need one for operating agreement. You need one for your operating account. That means everything that every transaction stuff you buy is going to come out of it. You need one for payroll. And the reason why you need one for payroll, whether or not you have a employer or not, is so that you can meet your payroll obligations without having to factor, without having to go and get a payday loan, or without having to do check kiting, which is depositing a check, cashing a check here, knowing full well you don't have any money in your account. Okay, and so you need to do, and the third account you need to have is a marketing account, because that's the expense that usually gets pushed to the side when you're broke. You stop marketing, and you have to have marketing money. And for some of you have to travel in order to market. Okay, I'm going over. So balance sheet tells you what you owe. The asset section tells you what you own. It's truly not an asset if you owe more than you own. I'm just going to let you know. They're just going to pull up, take your asset from you. And if they can't take your asset from you, I'm so sorry, y'all. I hate to break it to you like that. What they cannot take, they're going to file bankruptcy over. And I think, but I don't know what it is now, but at one point in time, your creditors only need $10,000 to come together and file bankruptcy and force you into bankruptcy. I don't know what it is down here, and I don't know if it's changed. I don't keep up with it, but I'm just letting you know that if what you owe is more than what you own, and people get tired of waiting for you, if you don't file bankruptcy protection, do what you have to do. And I'm not a lawyer, so go consult your lawyer, please. It's possible that your creditors can force you into bankruptcy. Again, let's talk about it. Is your current asset greater than your current liabilities? If it is, then you have the ability to pay your debt. If your cash and cash receivable, if it adds up to the cash and cash receivable in your current assets, and if it adds up to your liabilities, such as your accounts payable, I mean, I'm sorry, but you're just not in a good position. So we're looking to make sure that if I take your current assets and divide it by a current liability, that the answer to that has to be more than 1. It has to be more than 1. I need to know that your asset, you have enough asset to cover your liability. If that answer is less than 1, you don't have enough assets. So write that down so you can go look at your financial statement. Take all of your current assets, everything that you have that earned for this year, and subtract it by current liabilities, everything that you got to pay for this year. And if your answer that you get is less than 1, you don't have enough cash to meet your short-term obligations. Equity, we talk about it. No more negative answer. That should be your motto. No more negative answer. No more negative numbers, please. If you have negative numbers, you really don't own your company. Anybody can come and take it away from you. Your job is to build up your equity, and the fastest way to do that is to stop taking money out of your profit and start making sure more money goes into your balance sheet. We talk about the cash flow statement. It measures how well your company manages your cash. I'm going to fast forward because I want to show you. Because we're about to close out. I want to show you something called trend analysis. I'm going to go into more details about it. So when you're looking at this financial statement right here, a trend shows you the change in your financial activities from one period to the next. You can study it on a month-by-month basis. You can study it by a year-on-year basis, and you can study it on a quarter-on-quarter basis. So that means you can study first quarter versus second quarter, first quarter versus third quarter. And what you're going to take that same spreadsheet that I showed you with the formulas, and you're going to plug that data into that spreadsheet. It's going to help you identify weak areas in your business. It's going to help you identify fraud, mismanagement. Is going to help you identify opportunities for growth and the next step that the company should take. So I'm going to give you an example. We know that every year Essence Fest comes to town. All right, we already know Essence Fest comes to town every year. Well, when Essence Fest comes to town, a lot of restaurants are packed, everything is busy, okay? But the restaurant owners are so busy during Essence Fest that they don't have a chance to really take control of, assess what's selling, what's not. They're just reacting. We need more oysters. We need more shrimps. We need another poor boy bread. Call Leaderman. We need more poor boy bread. Here's what you're missing. At the end of this whole summer season, if let's just choose a restaurant, I don't know. We're gonna call it it's not KFC, but let's just call it Louisiana's Finest. Okay. If at the end of the whole summer season, Louisiana Finest compares January to June or January to March, okay, April to June, and then July to August, if they're looking at their revenue and their expenses during those months, they will see a sudden increase, okay? Now, in their mind, they know they made money because the revenue was really good. They're like, man, we made a whole lot of money off of these Essence folks people, okay? What they don't know is what restaurant items sold the most. If they're not tracking their sales down to the finest detail of what item on the menu sold the most, they're not gonna know which item they need to buy more of. They're not going to know which item they need to negotiate with the supplier for. So if you're buying 1 million oysters and you're paying 75 cents per oyster, and you're selling each oyster for $1, but you're buying 1 million oysters on the shelf, okay? And you're doing this every month, every time, every year, and you're paying the same flat price of 75, but come Essence Fest, you sell $2 million 2 million oysters. You're buying 2 million oysters, and you're still paying the 75 cents for the oysters. You just left money on the table. You have to go back and negotiate with them and say, hey, can you sell me an oyster for 60 cents instead of 75 cents? And in return, I can guarantee I'm gonna order 2 million oysters on a shelf for you. That's what trend analysis does. If you do it right, it helps you to identify when you're going to have an increase in sales or when you're going to have a decrease in sales. If you narrow it down some more, you're going to be able to identify which product or which item on the menu is selling the most and which one is selling the least. And if I was you, if come Essence Fest, the poor boy with chicken ain't selling, then you need to stop selling poor boy with chicken, because it ain't making no money. Sell it with fish. They come here for fish too. Or buy less chicken so that you don't have excess chicken in the freezer. If you know that you get about 500 people in your restaurant during Essence Fest, and you don't want to have those people waiting 2-3 hours, you need to shrink your menu, sell only the top stuff, make sure you have a variety for people, and get those people in and out as soon as possible. That is what trend analysis does. It helps you to manage your business. It helps you to manage your money. It helps you to identify opportunities for growth. It helps to point you in the right direction of what's the next step for you. Because you don't need to order $2 million of oyster. You don't need to order $2 million in oysters come the middle of July. Essence Fest is over. Now you're gonna have to sell your oyster dish for 50 cents, and now you're losing 25 cents instead. I hope you understand what I'm trying to tell you. The importance of your financial statement is more than just submitting it to the bank for a loan. It's more than just saying, hey, I made $1 million this year. Yeah. No, it's about using it to make better decisions for your business, to determine where growth opportunities exist, when you have to make a shift in your spending habits, when you have to get rid of stuff on the shelf, when you know you don't need 5 people in your restaurant because only 5 people show up during the morning hours. It allows you to adjust for the number of employees you need. That's the importance of trend analysis. If you're in construction, you will learn that there's some things you don't buy at a certain time. You will plan for layoffs. If you have good employees, I know a firm who refuse to lay off anybody. He give them a check all the time. They get a check because he wants to make sure that when business picks up, he gets the same quality work. And those are the things that you have to take into consideration when you are when you're conducting business. Do you guys have any questions? If you have any questions, please, my email is benita.rice@gmail.com. If you want to send me the questions there, that's fine, because I don't think I'll be able to answer the questions through the Zoom chat after this. Thank you all for coming out, and hope to hear from you. And if there's anything else you need to know, please let me know. Thank you.